So we are now halfway through the current year. Let's see how the Sifter Fund has performed. The main themes in this report will include top and bottom performers, global equity diversification, and finally, a deep dive into the companies in the semiconductor industry. Welcome aboard. Let's start by reviewing how the Sifter Fund has performed during the different phases of this year. The first quarter was positive for Sifter investors, with a rise of 7.3%. Technology, semiconductors, and pharmaceutical companies generated the best returns among the fund's holdings. The second quarter started with a slight decline in April as the market nervously awaited the company results, which turned out to be better than feared. Therefore, investors' appetite increased as a result of a positive outlook for these companies, leading to an additional 7% rise in May. Towards the end of the quarter, in June, market calmed down but still stayed positive, generating a 0.3% return for Sifter investors. All in all, the second quarter was very strong for Sifter investors, providing a 6.9% return, and since the beginning of the year, Sifter Fund has generated 16.5% return, which is better than the global stock index. Next, let's see which companies in the fund performed the best during the second quarter. The biggest gainers in the fund were the Disco Corporation from Japan, BE Semiconductor from Netherlands, and Lam Research from US. We will discuss semiconductor industry in more detail with Sifter's portfolio managers shortly. Among the biggest underperformers in the second quarter were Northwest Company, Universal Music Group, and Disney Company. According to our assessment, none of these declining companies have permanent business issues, but each has its own minor concerns. For example, the Disney Company is actively contemplating how to make their streaming business not only strong in terms of growth, but also profitable. This creates uncertainty for Disney's stock price. The Northwest Company, a retail store operating in Canada, has struggled to keep up with the growing turnover and margins after very strong years during the pandemic. Although the company is a consistent earnings generator, our concern is related to its growth prospects and slightly declining margins in the Canadian backwoods. Let's talk a few words about the evergreen topic of equity diversification. The role of equity diversification has once again emerged as a crucial factor when seeking returns. Nobel laureate Harry Markowitz once said that diversification is the only free lunch in investing, meaning that diversifying is the way to increase an investor's expected return without adding risk, or in other words, reducing risk without sacrificing returns. Even though Markowitz's research was published back in 1952, people still tend to over-concentrate their investments in a single market area, such as solely in the United States or the Helsinki Stock Exchange, for example. Investors worldwide tend to have a home country bias, favoring familiar companies and stocks in their own country. And this tendency is very human but exposes an investor to greater risk and potentially lower returns. Well, let's make it more concrete and compare various indices around the world and their returns in euros. The S&P 500 is one of the world's best indices because US companies are not only very good, but their valuation multiples are often relatively high compared to European or Japanese companies. There are at least two reasons for these high valuations. The United States as a superpower enjoys a safe haven reputation, and secondly, growth expectations for US companies are often very high, sometimes even too high. Well, nevertheless, the S&P 500 index has been a very good investment for investors around the world in almost all periods of time. In Europe, for example, the German DAX index has performed extremely well this year, but over the long term, say 5 years, the returns have been mediocre. Japan's Nikkei 225 was a miracle in 1990s until it wasn't, when the bubble burst completely. During the current year, Japanese stocks have shown strong growth, especially in a local currency. But when converted into euros, the returns are almost on par with the DAX. The Helsinki Stock Exchange has been a tragedy. During this year, the index has suffered a decline of over 5%, but even more disappointing is the fact that the last 5 years, the index has produced roughly 29% cumulative return. When maybe the only positive thing is that the Finnish investors have been comforted by the good dividends offered by large Finnish companies. The closest unofficial benchmark to Sifter Fund is the MSCI All Country Weighted Index, which is a global stock index consisting of a bit less than 3,000 companies from 47 countries. It has performed better than individual country indices in the table, but still falls behind the S&P 500 or Sifter's focused high-quality portfolio. Let's take a look at how globally diversified investment portfolio looks. Currently, Sifter's portfolio is well diversified across 9 different countries. The US accounts for slightly less than 50% of the portfolio and has remained at the similar weight through the spring. In terms of sector allocation, we follow companies in sub-industries, totaling 19 in the portfolio. At Sifter, we don't diversify just for the sake of it, but rather we find good quality companies regardless of their origin. And the current broad diversification of the portfolio is a result of our research process in seeking the best companies around the world. The most significant change in sector allocation during this past year has occurred in the growth of semiconductor companies and the equipment manufacturers. The combined weight of these companies in Sifter's portfolio has risen from 18.6% to 22.3% over the year. Next, let's get into the semiconductor industry and the companies in which Sifter has invested in this sector, and I have invited Alexander Järv from Sifter Portfolio Management Team. Welcome, Alexander.
Thank you, Santeri.
Could you shortly describe the semiconductor value chain and what kind of companies and could you break down the value chain that we could all understand better?
Yeah. So semiconductor industry as a whole is a $600 billion industry, and it's growing about 10% every year. And a lot of analysts and industry participants are saying that within 10 years, this will be a $1 trillion industry. I personally like to divide this into like 4 separate boxes. So in the first box, we have capital equipment manufacturers. So these make the tooling that they then sell to the so-called semiconductor foundries. These are the semiconductor factories that use the tools to make the chips. They then sell their capacity to the third box, which is the chip designers. So, for example, Apple designs their own chips, but they don't have their own foundries, so they use someone else to make the chips. We've got NVIDIA as well, another good example. They design these graphic cards, but they don't make the chips themselves. And then lastly, we have like the end product. So again, talking about Apple, the chips get put into the phone and then sold to the end consumer.
So it's a huge industry.
Yeah, 600 billion.
600 currently. Yeah.
Currently, yes. And it's the third largest capital good in the world.
So how many investment opportunities one could have in that industry, like a public traded companies?
I think the number of publicly traded semiconductor companies are 963, roughly.
So there's plenty of opportunities.
There are. The biggest company right now is NVIDIA, thanks to its meteoric rise this year. Other big companies in this sector is Taiwan Semiconductor, Intel, AMD.
Okay. But what is driving the growth? What are the reasons for that?
So there's 2 main drivers here. Firstly, the number of data that humans generate double every other year. And this number is now measured in petabytes. It's a very large number. So when the data that's being generated doubles, you need to store that somewhere, and that requires better storage chips and faster chips. And also this data which you generate, it needs to be processed somehow. The raw data itself is kind of useless, so you need to process this to get the actionable data you want from it. And that requires more processing speed. If the number of data doubles and the speed remains the same, it takes longer. So more data and faster processing are the main drivers for growth.
Okay. And how about the typical application use cases that we know that it's iPhone and maybe laptops, but what else?
The biggest segment is cloud service providers, so servers in the cloud. Yeah, of course, but chips are being used everywhere nowadays. In the toasters, in the lamps at home, for example. I have these Philips smart lamps. Cars now have thousands of chips in them, whereas 30 years ago there was one chip per car.
One chip for one car, and nowadays thousands. So they are being integrated into everything, dumb chips and smart chips alike. So this is why it's growing so fast. And how would you evaluate all the players in the value chain? Are they contributing and getting the benefits out of that growth, or is it how is it distributed among the players, this growth?
So it's not exactly equal. I like to think about it as the leading edge companies that have the latest high technology, and then the trailing edge, which are using like older, more refined technologies. So there's more competition. That's another way to say. And basically, everyone is gaining from increased volumes. More chips are being demanded every year, but the ones that are in the trailing edge, there's more competition, so there's more price bidding downwards for these companies. So they get benefit from the volumes, but not the price. While as the leading edge, like we got Taiwan Semiconductor, again, is a good example. They are the only ones that can make the chips for the next iPhone. The only one. So they have the pricing power on top of the rising volumes. So the leading edge companies are therefore benefiting more from this growth trend.
So each company is growing, but the leading edge companies are getting the most of the margins.
Yeah, they are taking most of the cake.
Yeah. Okay. So how about the competitive advantages? How do you see what are typical competitive advantages for these kind of semiconductor companies?
So the main two advantages that I see is scale benefits and then technology. If you take scale, for example, and again use Taiwan Semiconductor, it's a good example for this kind of situation. It is the world's largest independent foundry. And when they build the next generation foundry for the next generation technology, they have to invest between 30 and 50 billion US dollars for one factory.
Okay, well, it's a really big investment then.
It's a large investment and it's very hard for competitors to replicate.
Yeah.
You basically need to get all of the high leading edge volumes to make a good return on your investment, and therefore competition is very unlikely in that case.
Okay.
And the other main advantage you can have is technology and accumulated know-how. So the whole process of making a semiconductor is very complicated. We're talking about tens of thousands of parameters that need to be adjusted.
Right.
It's very hard to do. Another good example here is the Dutch company, ASML, which make extreme ultraviolet lithography machines. They spent 20 years developing this one machine.
Okay. So very high barriers to entry.
Very high indeed, yes.
And then the technology advantage, scale advantage.
Yeah.
And maybe cumulative learning as well.
That's really important as well.
Okay. Are those competitive advantages, are they reflected in the business numbers, the figures also?
Yeah, you can clearly see that the leading edge companies have better margins. So if you take the operating margin, for example, Taiwan Semiconductor has 50% operating margin. The largest kind of equipment tool makers have between 30-40% operating margins. And then if you look at the trailing edge, where there's more competition, the margins there are typically between 10 and 20.
Okay.
So the leading edge companies have better margins and they get more of the revenue as well.
And because there's a high barriers to entry, so it's very difficult for competitors to come and take the piece of the cake, nice margins.
Indeed, yes.
Yeah, okay. How about risk? Are there any risk what you can see and identify in this semiconductor value chain and the businesses we have invested in?
Yeah, so first, it's more cyclical, this industry, than your typical industry, or more cyclical than the economy in general. But lately, the kind of risk that has been arisen the most has been the China risk. And this is specifically targeted against Taiwan Semiconductor. So, as the name implies, this company has most of its assets on Taiwan, and China has said that they want to reintegrate Taiwan with the mainland. And if that would occur, then that would potentially be devastating for that company.
Okay.
On the other hand, the kind of rising China tension has led to a kind of trade war where every major continent is now trying to get their own domestic chip production up and going. And there's several major chip funds that provide subsidies and tax credits for investing into new capacity.
So this risk can be also opportunity for some companies.
For the tool equipment manufacturers, this is a huge upside.
Okay, very interesting. And could you wrap up that in which kind of businesses we have invested as a Sifter fund in this value chain?
Right. So we have Taiwan Semiconductor, which I've been talking about quite a lot. They have the scale and the technological advantage. We also have 4 tool makers. We have Applied Materials. We have Lam Research. They are both leading edge player in the kind of tooling market. They have both about their own large market share there. Then we have this kind of interesting small-ish Japanese company called Disco, with a really great name. And Disco makes saw and saw blades, which might sound a bit boring, but very precise saws needed to kind of cut the finished chip out of the finished wafer. This is a very small niche market in which there's only 2 companies
in the world.
Yeah,
Okay.
of which Disco is the largest of those 2.
Okay.
And then we have a Dutch company called BE Semiconductor, which makes these kind of packaging machines, which are also an important part towards the end of the process. And then lastly, the 6th company we have is Texas Instruments. They make these kind of old-fashioned analog chips, which are not high-tech in any way. But they are the biggest company here, and they have this kind of scale advantage. So they can produce these chips at a lower cost than its competitors. And therefore, they have a 50% operating margins on these bulky chips as well.
All right. So we are invested in 6 different companies in the value chain, and of course we are looking for good quality businesses inside this value chain. But currently, we haven't found any better ones. There might be.
There are other good alternatives out there, but it's not been justified to change our composition.
All right.
Due to that.
Well, let's see. Maybe in the future. So this is the last video before the holiday season. Although all kinds of surprises can happen in the world and on the stock market during the summer months, we think we can go on vacation with a calm mind. We can count on the fact that the high-quality businesses will survive even in difficult circumstances. And this is one of the benefits of long-term quality investing. Thanks for joining again and have a great summertime.